right. Well, welcome everybody. We're right on time, maybe just 1 minute late. Let's go ahead and get started. So, welcome to our webinar. Our webinar today is Decoding 280E and Current Developments. I think that this has been a very hot topic, if not the most important topic of the year since TrueLeave announced that they would be filing for refunds, and then in a subsequent earnings call this year that they had in fact received them. I think that set off a flurry of discussions across the industry, and we'll have Nick Richards here as our presenter today. And I think he's been, in my opinion, the most outspoken and has been more forthright in sharing information, whether it be articles that you may have read from him or various other webinars. Really glad to have him today, and I'll introduce him here in just a second, but we got to go over a few housekeeping items. First, welcome again. My name is Guillermo Rodriguez. I'm a virtual CFO here at Summit Virtual CFO by Anders, and I'm also the host of the Cannabis Success Show, and I'll be facilitating our webinar today. We're not on Zoom, we are on Teams. So if you have a question for today, please just use the Q&A. We will try to answer questions, or we'd love a discussion. So if you have questions, we'll weave them in. If not, we could also, if you'd like to save them for the end, we could answer all the questions, and we'll have some time at the end of the webinar. The replay and the slides will be sent out to you within 2 days after our webinar today. So just a little bit about Summit Virtual CFO by Anders. We started as a traditional CPA firm back in 2002. In 2004, we started offering CFO and back office accounting services. Then in 2013, the firm became fully distributed. This was even before COVID. And then over to 2022, Summit Virtual CFO joined Anders, and we all became one firm. So now our brand, there's Summit Virtual CFO by Anders, and we have a team of hybrid and fully remote team offering advisory and back office services to our clients. So today we have Nick Richards. I'll let him tell you a little bit more about himself, give you an introduction. But he's a tax partner and co-chair of the Cannabis Law Group, and he's also with Greenspoon Martyr LLP. He'll be our presenter for today. So with that, let's just go ahead and get started, and I'll go ahead and turn it over to you, Nick.
Thank you, Guillermo, and thank you, Anders, for this opportunity. Appreciate the opportunity to talk about this new stuff that's out there. So, before we get into it, I just want to say this is all sort of cutting edge, uncertain tax position, new stuff, no cases, that kind of stuff that we're going to be talking about today. So, none of this is really legal advice or anything like that. It is a discussion about what is out there and what the industry is trying to prove moving forward. Okay. A little about my background. I was lucky to be an IRS trial attorney right out of law school. I spent about 11 years with the IRS, first in the field in the LA U.S. Tax Court, and then I was a little bit of a sort of a rogue IRS guy. I started a new program that sort of got some feathers ruffled, but also got me noticed and got me a request to come to Washington D.C. and work on a national scope and train agents and do those kind of things. So I did that for a couple of years, and then that got me to Denver, where I am today, coming to you from Denver. And I think it was 2011, I left the IRS and joined private practice and got one of my first cannabis clients that was under audit by the IRS, and learned about 280E, and here we are today. I was lucky again to be here in Colorado when that all kind of got started. And if you were a new state and a new business in a new state, you had a guy from Colorado on your team, and that guy or woman may have known me, and it was really great for me. So Guillermo, let's go to the next slide. So we're going to be talking about 280E today, right? And 280E is a weird thing, and I want to talk a little bit about why it's weird on one of the first slides. But first, let's get into a little bit about what we're going to cover here. So we're going to talk about this current battle to prove that Section 280E is not applicable. A large public cannabis company called Trulieve initiated that battle sort of publicly, along with another case called Canna Provisions that's out of the Southern District of Massachusetts. We're also going to talk about Section 471C. That one's been around a little bit longer, and how it's being used by the cannabis industry. We'll start with 471C. It kind of sets some of the basic principles around 280E and the way it works within our system. That's kind of important to understand the bigger picture. And then we're going to talk a little bit about whether past 280E costs can be recovered after rescheduling, and that's a topic that's on a lot of our minds right now. And there's a decent argument that they should be able to be recovered, and that'll probably be the next fight we see if the IRS disagrees. And so, real excited to be presenting those topics today. Guillermo, how about that next slide? So there they are again. In more bulleted form, we're going to be talking about some basic concepts. Section 471C. I call this concept around that you can be able to claim 280E costs down the road. I call that the 280E capital asset. There's probably a much better term for it, but that's the one I've been using. We'll talk about the interstate commerce method. That's the Trulieve approach. And then look, on questions, would love to see your questions come up during the presentation. Happy to take them as we go, or there'll be some time at the end as well. Next slide, please. Okay, so Section 280E, like I said, it's a weird bird. And it was created during sort of the height and the fervor in the war on drugs, at a time when anyone who was in Congress wanted to appear tough on crime. And essentially what happened is an illegal drug dealer was arrested and then charged tax for the sale of illegal drugs, and went to court and requested deductions. The IRS said, no, you don't get your deductions. The deductions were things like this person's scale, cell phone, home office, a topic that, probably drug dealers shouldn't request his home. People with home offices get audited anyway, right? But things like that, right? And he went to tax court and he won. And the court basically held, look, there's nothing in the code that says that you don't get these deductions. And so that got the attention of Congress, and they created 280E. They wanted to disallow all costs. And if you look at the congressional record around 280E, what it says is that it does not affect cost of goods sold, because if it did, it would violate the 16th Amendment to the U.S. Constitution. The 16th Amendment's definition of income. So income under this is a defined term under the 16th Amendment. The 16th Amendment is what authorized our income tax. There was no income tax prior to the 16th Amendment. And the term income is then a constitutional level term that is defined as gain. And critically, if you're going to tax the revenue from the goods sold, the 16th Amendment requires that you give credit to the cost of the goods sold. If you fail to do that, it doesn't reflect the gain from the goods sold, and it's unconstitutional, right? So that's cost of goods sold. And it's really interesting, though, they could disallow deductions. Why is that any different? In the end, Guillermo, if we look at these costs, they're all ordinary and necessary business expenses, right? And by definition, they're ordinary and necessary for the production of income. There's that term again. But here the government can disallow deductions. Why is that? Why can't they take away cost of goods sold? You mean to tell me, Guillermo, that if I'm a cannabis company, the government has to give me credit for the price I pay for the marijuana that I sell, but I can't deduct the cost I pay my CPA? Is that the way our system works? It's amazing, right? 280E is a square peg in a round hole. It doesn't fit in our system because these are ordinary and necessary business expenses. And so what's the difference here? The basic difference is timing, right? Remember, if you're going to tax the revenue from the goods sold, you have to give credit to the cost of the goods sold. These other costs, then, they're not necessary to give credit to current income. And what do you do with costs like that? You carry them forward, right? They're ordinary and necessary business expenses. They're not necessary for current income. Carry those costs forward until they are necessary, right? And that might not be until you sell your business, and we'll talk more about that. But this is 280E. 280E is weird in our system, right? And we still don't have an answer to this part that I'm posing here. We still don't know what happens to disallowed costs under Section 280E.
Yeah. And Nick, when you talk about timing, you said when you sell the business, and I know you're going to go into the detail, but that legislative grace also applies to recognizing the sale right and recognizing the cost upon sale. So when you go into inventory, the legislative grace is also that you don't get the offset when you pay for the expense, but when you sell, if you're using an accounting method that matches the revenue with the expense, right? So
I think that's right.
Yeah.
Yeah, Guillermo, I think that's right. Of course, we have a case called CBS. It's not on all four squares, right? But it is useful, and we'll talk about that case. And the concept that you mentioned, legislative grace, right, is really important, right? That every case we have out there on 280E gets to this question of, wow, is that income? How does that work? You mean to tell me that they have to pay tax on all this money that they don't have? How can that be legal? And the answer is deductions are a matter of legislative grace. It cuts both ways. That means the legislature can give them and take them away. The legislature can't violate the Constitution, though. So what does that mean? That means that deductions must be essentially early credit for costs that aren't yet mandated under the 16th Amendment because they aren't yet directly tied to income. That's what a deduction must be, right? Think about it. Bonus depreciation. The concept of depreciation ties useful life, ties the use of the asset, the expenditure, to the income it produces over its useful life. That's the 16th Amendment at work, right? Bonus depreciation is a deduction that allows early credit for costs that aren't yet tied to current income, right? It's the way our system works, and 280E now fits in there. And what does that tell us? When you take these two pillars of constitutional authority, legislative grace, and the definition of income, they seem to conflict unless the costs don't disappear and they can be recovered later. Once you realize that they could be recovered later, now those two basic core constitutional principles are in harmony, and 280E appears constitutional. That's my soapbox, Guillermo. I get passionate about that, right? Because it has to work that way. The IRS does not have the authority to deny credit for an ordinary and necessary business expense. That they can't. If they do, that means they can take away anything. They can't do that. They are bound by the Constitution as well. Next slide, please.
And Nick, does that have something to do with as well, where 280E really states, and it's such a short paragraph, but where it states that, shall not have within the current year, or uses the word current year, and where the
that's that term, paid or incurred during the current year, or during the taxable year. And one of the things I think about on that, Guillermo, is that, right, a salesperson cost. You pay that cost, 280E affects it. It's clearly a trafficking cost that's subject to Section 280. It is really the classic one, right? And it's then paid and incurred in that year that it's disallowed. Well, now, if you capitalize it and carry it forward to the next year, it's no longer paid or incurred during the taxable year. Mm-hmm. So now, does 280E still apply to that cost, or now can we deduct it? That's another question that's still out there that hasn't been answered yet. But it's interesting that there's these little pieces in our code that suggest that somebody's aware of this and is thinking about this as these are coming out. It just hasn't yet been established.
Right. You think if it would have been more clear to say in the current year or any future year, then you would be talking about this, right? But it was just a couple of words were left out that leaves it open to some interpretation.
Yeah, I think that's right. And then there's that next underlined portion there, consists of trafficking, right? There was a big challenge around what it means to consist of trafficking, and it sort of culminated in a case called Harborside. But importantly, for rescheduling coming up, has to be a Schedule 1 or Schedule 2 controlled substance, right? For 280 to apply. Yeah. Okay, let's go on. Okay, so you get to this point and you say, okay, I'm a cannabis company, and the only thing I get to take this year are costs of goods sold. What are those, right? And that then gets us to section 471. Section 471 is a part of the Internal Revenue Code that sets forth what is and is not cost of goods sold. And the regulations and full absorption accounting and all of those things that we all studied and that we make our earn our living off of, those all fall under what is known as section 471A. And section 471A then gives the IRS the authority to determine what is and is not cost of goods sold, so to clearly reflect income. There's that term again, Guillermo, clearly reflecting income. It's all over our code, and it is a direct reference to the 16th Amendment and the ultimate requirement that we can only tax gain, only tax income. And here in section 471A, the IRS gets to say what clearly reflects income, and they've done that by putting forth what are known as the 471 regulations. That's the IRS's determination of what clearly reflects income. And Guillermo, one of the interesting things that we see if you read the cases out there is they all go like this: 280E can't be right, and then the court goes, well, the IRS 471A says the IRS has the authority to clearly reflect income. This is what they say. Have a nice day. And that's the way our cases go, and that's 471A at work. Under 471A, now there are different categories of cost of goods sold, depending upon whether you are a reseller, it's a dispensary, or a producer. And Guillermo, one of the things that most people in the industry understand this, and I know you do, is that if you're vertically integrated, now you can use the producer regs for your entire enterprise. And you get a little bit better treatment under 280E, under those producer regs, than you do under just the standalone, what are known as the -3 regs that resellers have to use. So that's why having a little grow or a little manufacturing facility or something like that, along with your cash cow dispensary, can put you in a better tax position. So that's 471A. 471A is very specific. It says these things are cost of goods sold, these things are not. Along comes 471C in the 2017 TCJA Tax Act, right? And section 471C then is what is known as the small business exception to the inventory accounting. And for cannabis companies, the specific method that we use under 471C is known as the non-AFS method. AFS stands for applicable financial statements. That's really a GAAP statement is what an AFS is. And GAAP and 471C are not compatible. But Guillermo, one thing I want to say, and I know there's a lot of CPAs on this call that has spent a lot of time and probably money learning everything there is to know about full absorption inventory accounting, but guess what? It is not the law. The regulations for the -11, the -3 regulations, not the law, just a regulation. Full absorption accounting, not the law. GAAP, not the law. 471C is the law. Okay, that is really, really important to understand. And if there's a conflict between the two, guess what wins? The law, right? And that is really important to understand. And Guillermo, 471C got a lot of people pushed back because what it says, and we're going to get into that. And a lot of people said, well, that doesn't work. That GAAP, you couldn't do that under GAAP. And the answer is, it doesn't matter. GAAP is not the law. 471C is, right? Okay, so that's really important. So what is 471C? So 471C basically says that for a small business taxpayer that's under 29 million, that doesn't have a GAAP financial, that section 471A does not apply. And so long as the taxpayer reports its inventory on its tax return according to its books and records, meaning tax return matches the general ledger, that reporting shall not fail to clearly reflect income. There's that term again, right? That constitutional level term, right? That is the basis for cost of goods sold in the first place. Here, 471C says that power that's usually the IRS's power, we're taking that away from the IRS and we're giving it to you, taxpayer, according to this one test, reported according to your books and records. It is a remarkable code section, and it really flies in the face of everything else in the Internal Revenue Code. And it got a lot of us thinking, what the heck is that? Are they high or what? What are they doing? And so it is an uncertain tax position. It does require disclosure, but it is a remarkable code section because it gives this core power to the taxpayer.
Yeah. And does the 29 million, if you have a vertically integrated company that's got 3 different entities or 3 different tax returns, does the 29 apply in any way in a combination of entities, or is the 29 per file per return?
If there's common ownership, it applies. You aggregate those companies for determining the 29 million, and it's 51%. And any 2 companies owned more than 50% by a single company or a single person are aggregated for purposes of the test.
Of the 29. Okay.
Yep. And again, on these applicable financial statements, right? Guillermo, they're out there in the industry. And one of the places that they show up a lot is with lenders. A lot of lending agreements in the space say you have to give your lender a certified GAAP financial every year. Guillermo, I've talked to every lender out there. They all now understand 471C, and they will take a certified 471C financial as well. They're not going to stop their borrowers from using a legal code section, right? Now they're beyond that, they're not getting into it, but it is something that you are entitled to use. The question isn't should you or shouldn't you use it. If you qualify, you should be using it. The question is how aggressive to get with it. And it isn't a matter of do you qualify for it or not. It's a matter of how far do you go with it.
Yeah. And and you're right, most of the credit agreements that we see for loans out there, they'll have the language in there that GAAP financials are required, but I have actually not seen the banks really enforce the requirement for full-on GAAP audited financials or reviewed or compiled financial statements. So you're saying that even if there is an agreement out there that requires a company to have GAAP financials, so long as they don't produce them, they could go ahead and apply 471C.
That's right. And then it's a discussion around risk and how far you want to push with it. I think there's a pretty reasonable position to take that gets a lot more into cost of goods sold. There's a lot of flexibility with 471C, and so it has a lot to do with the CPA and the taxpayer's comfort level on how far they want to go. Guillermo, I always want to talk about the 280E asset in connection with 471C as well. I think they work well together. The concept then that under this accounting method now that doesn't limit cost of goods sold, supposedly, theoretically, that now we can start to recoup the 280E capital asset up to the level of income that's there that we can attach it to. Can't go beyond that, can't create a loss, but up to that level. So we used 471C to kind of get to this ultimate timing position where we can start to recoup those past 280E costs as well.
Okay. And for the participants that aren't as familiar with the accounting terms, when you talk about capitalized terms, you're referring to any costs that are incurred or paid in the current year, and they're not expensed for tax purposes. You're basically putting those on the balance sheet and as an asset, and so they roll over into the next year.
That's right.
Yeah.
And I think there's 2 steps to the thinking on that. Number one, putting it on the balance sheet and carrying it forward, there's no tax effect there, right? So that's not a very risky thing to do in the tax world. Actually, putting it back into cost of goods sold is where you take your risk, right? But for a lot of people out there that says, that's too aggressive, you should really think seriously about nevertheless putting it on your balance sheet, recording it, carrying it forward, because it could become useful with rescheduling, right? And we'll talk more about that.
Right. What you're saying there is, regardless of what your level of risk is, if you're how you're filing your return, to really keep track of those essentially non-deductible costs on your books, to make sure that when you make the decision to file an amended return, that you have the right cost captured that you'll eventually deduct again on your amended returns, correct?
That's right. Yep, that's right. And keeping track of those is records are tricky in the cannabis space, right? Because of lack of, services and the things that normally make keeping records simple, like things like bank accounts, could be difficult in the space. So, okay, next slide. I think we've got, I think we've got some treasury regulations to kind of talk about real quick. But before we do, I want to just, this slide wants to hit again on this concept of who gets to say what clearly reflects income. And there's a number of pieces to that. And generally, as I said, that's generally the IRS's authority. And you think about like things like C corporations that own real estate and have rent. And, the classic example of, owner of the C Corp also owns the real estate, and that's in an LLC. So we push the rent up, right, in order to get it out of the C Corp into a flow through a single level tax, right? The IRS can come back in then and say, no, that rent's not fair market value. We're going to recharacterize that as a dividend and tax you accordingly to that determination. That is the IRS's power to clearly reflect income, right? And it also exists in accounting methods. The IRS has the power to change an accounting method so to clearly reflect income. Again, the power of 471C is it clearly reflects income by law, right? And the IRS doesn't have the authority to go around that if you comply with it. So it's really powerful. And some other interesting quotes out there coming out of some of the cases in Harborside. The court said that if Harborside could establish that Section 471 permits it to include costs in cost of goods sold, Section 280E would not prevent that result, right? And another case, Orange, stated that the IRS has no authority to change a method if consistent application of accounting method provided in the Code of Regs. All 471C says is reported according to your books and records. If you comply with that, these powers seem to not apply. So again, it's very powerful. We'll see in the coming years whether how far we can get with it. But it really has a lot to it. Next slide, please. Okay, it's kind of interesting how this happened, Guillermo. A little bit of a story here. When 471C first came out, it was during the IRS's real fight against the cannabis industry. They had targeted the cannabis industry with what's called a compliance initiative project, put probably 90% of the cannabis companies in Colorado under audit, and were trying to enforce 280E against the cannabis industry. And during that sort of heyday, during that fervor that the IRS had, Section 471C came out, and professionals started talking about, hey, look, we might be able to use this to get around 280E. And then in 2020, a federal agency called TIGTA, the Treasury Inspector General for Tax Administration, TIGTA issued this report. TIGTA's job is to audit the IRS and to issue reports, and it did that. And it audited the IRS's 280E targeted audit program, and it issued this report. And this report is just glowing of that program. It says things like, hey, IRS, you collect $3 for every $1 of every other compliance initiative program you do. And the IRS says, yeah, we love it. And it's in that kind of finding, recommendation, answer format where the IRS, with TIGTA says something and makes a recommendation, and the IRS responds. And it goes through, and TIGTA says things like, hey, you should go get everyone's license number and put them all under audit. And IRS says, we're already doing that. And it kind of goes along like that for a while. And then TIGTA says, but hey, IRS, there's this code section 471C, and these professionals are saying they can use it to get around 280E. And then they do this chart where they show just that. And then they say, you should issue regulations on the interplay of Section 280E and 471C. And then the IRS responds, and it's redacted. Guillermo, it's the only thing in that report that's redacted. And that got a lot of our attention, right? Why did they redact that? It just said issue regulations that discuss the interplay, right? And so that seemed fairly straightforward, that we all wanted to see that. And the IRS, whatever the IRS said, couldn't be for public viewing, right? We still don't know what it said. But what we do know is that the final regulations were ultimately issued. And guess what they don't reference? 280E, not in there. remarkable, right? I mean, TIGTA has a lot of power over the IRS. Usually the IRS does what TIGTA says. Here, TIGTA says do this, and the IRS says something that we don't know. And then when the regs come out, it doesn't mention 280E. As a matter of fact, it even says that you can't inventory a cost that's not deductible or otherwise recoverable. And then it lists those costs, and 280E is not in there. Remarkable, right? Another one of these little pieces that's in our code that seems to suggest that there's more to it than we have seen from the IRS disallowing deductions and assumingly taking the position that they disappear, right? Here, 471C seems to contemplate something else. And so, nevertheless, these regulations are out there. They do make statements that you can't inventory costs that are non-deductible. And for that reason, we have to disclose. We have to disclose to the IRS via Form 8275 or 8275R. Guillermo, some people want to take the position that because it says that you cannot deduct a cost that's non-deductible or otherwise recoverable, that statement, otherwise recoverable, is a little carve out to the 280E capital asset method. And because 280E costs under that theory can be recovered, now 471C isn't saying that they're disallowed. Again, another little place where could be that if these theories are right, that the code actually supports it. So that's where we are on 471C. I think, Guillermo, what's the next slide? Are we going on a new topic, or is it still, yeah, the otherwise recoverable and the 280E capital asset topic? Let me just, we've kind of talked that through a bit, and it shows up a little bit later with rescheduling. But before we move on to the next topic, I just want to say this. There have been some audits. The IRS has been really weird about 471C. They don't want to talk about it. They won't do events where 471C is on the schedule, and they won't talk about it. The most they'll say is they better match, your records better match your tax return. I have had audits. Other professionals like me have had audits. We are not seeing a consistent approach from the IRS. I have had no changes in some audits that were clear 471C, and I had a 471C no change that they put everything into cost of goods sold. And I've had other ones where they want to fight. I'm not sure where the IRS is right now on it.
Yeah. Nick, so when we talk about the different methods, it seems like some are riskier than others, because the question we'll eventually get to is like, you decide to file an amended tax return. You do in fact receive the funds. It's an uncertain tax position. So how long should you wait until you spend a portion of those funds, or when you feel safe that the IRS isn't going to claw that back? But you're saying with 471, if you've already passed the initial audit, then those funds are safe to use, would you say? And
yeah.
Okay.
Yeah, and you're not going to get audited again for the same year, certainly.
Right. And so the time,
and you probably won't get audited for the next year either if you get.
Okay. And how long do you usually see from the time of filing until that audit takes place? Is it 1 year, 2 years?
It's usually longer than 1 year, but less than 2 full years, because the IRS wants there to be a full year left on the statute of limitations when they open an audit. So that means if they're into the 3rd year, there's less than a full year because they have 3 years to audit.
Okay. So if you file an amended return using the 471C method.
Well, so Guillermo, the 471C method is not the amended return method. You can only use 471C. You could start off using 471C. But if you started off using a different method, you have to make a change of accounting election to do it. And you can only do that on an original return, on a timely filed original return. So the amended return method is the next one we're going to talk about. And they're two different things. They're not, if you can qualify for 471C, the amended return method might be better for you anyway. You can use them both. They're not isn't one or the other, but they're definitely two different methods.
Okay.
Yep. So let's go to the next slide and let's get right into the amended return method. Okay, so what is it, right? So it is a direct challenge to a case called Gonzales v. Raich. And you might remember that about 2 years ago, there was a case called Standing Akimbo that requested cert from the Supreme Court, and the Supreme Court denied cert. And in doing so, Justice Thomas made a statement that Gonzales v. Raich may no longer be good law. That got everything started. And now here we are today, and there's two things out there that are challenging it. Trulieve was a brave company took that first step and filed those amended returns and made those claimed those refunds and made those public announcements. And there's another case called Canna Provisions that's out of the Southern District of Massachusetts that is a direct challenge to the federal government's ability to regulate marijuana. So how does that work, right? So Guillermo, it's kind of interesting, right? So our system, the way our system works is the 10th Amendment to the U.S. Constitution states that any power not specifically given to the federal government in the Constitution is reserved for the states. And there is no federal constitutional power to regulate drugs. Doesn't exist. There's a lot of things that aren't in the Constitution that don't exist. Say also environmental laws. There is no express power to regulate the environment in the Constitution either. And the only way that the federal government has those kind of powers is through what is called the Interstate Commerce Clause. And the federal government has the right to regulate interstate commerce and the pathways of interstate commerce. Right, so our highways, interstate highway system, our interstate waters, and commerce that crosses state borders, interstate commerce. But generally speaking, the federal government does not have the power to regulate intra-state commerce, commerce that exists solely within a state and doesn't cross state borders. That's the cannabis industry, right? The cannabis industry doesn't cross state borders unless some independent third party buys weed in one state and takes it to another. That's not what we're talking about. We're talking about a company producing, distributing, manufacturing, and selling marijuana all within a single state, right? That's intrastate commerce. So in Gonzales v. Raich, it's a very early case, 2005, and participants in California's medical marijuana industry sued the federal government and said, hey, federal government, California has legalized this activity. It's intrastate, and you don't have the authority to regulate us under your interstate commerce clause. They lost, right? They lost because at that time, the federal government had an interstate policy of eliminating marijuana from the United States. And Guillermo, if in those early days of the California market, they were locking people up, right? In fact, that's what they tried to do with Raich, right? They tried to lock them up. And so they were enforcing it in those states. Now, 20 years later, things have changed, right? And that was Justice Thomas's comment that this very important fact that gave the federal government the right to infringe upon California's intrastate authority, that very important fact is no longer true. That very important fact is uniform illegality, right? And now we're 20 years down the road, Guillermo. It's been that long, right? This industry's been going. And now 20 years later, the facts have changed, right? And also some other things have changed, the law and the court as well. And so, Guillermo, I don't know if we have a slide on each of those, but I'm going to talk about each of them separately. First, the facts, right? So the facts that have changed now are we all know them, right? Things like Rohrabacher-Farr Amendment, right? Legal defunded the Department of Justice in prosecuting individuals and businesses that are in compliance with state legal cannabis activity. The Cole memos, the federal government authorizing Washington, D.C.'s medical marijuana program. Those facts are specific, but we all know that if you're in a state where marijuana is legalized, the federal government's not there. They've taken a hands-off approach, right? And so that key fact that was essential to allow the federal government to infringe on California's intrastate authority is no longer true. The other thing that's no longer true is the law. The law has now changed as well. Guillermo, I mentioned interstate waterways on purpose because there was a case last year called Sackett. And in the environmental context, a similar kind of dynamic has existed where the federal government has been allowed to regulate intrastate activity if it can point to some kind of interstate purpose, right? And in the past, think about that farmer with that wetland. They want to fill in that wetland. They're tired of farming. Farming's hard. And they want to build some homes and move to Florida. And so they go and they try to get a permit, and the federal government says, no. Clean Water Act says you can't fill in that. That's a navigable water of the U.S. Farmer says, what do you mean? This is a wetland. I'm 10 miles from the river. And the courts have actually upheld that 12-mile distance based upon the fact that underground there's a water table and it's all connected. What the court held is that in Sackett is that unless there was a surface water connection, unless you could paddle a canoe at low tide from the wetland to the interstate waterway, unless there was that actual physical visible connection, that there was no federal jurisdiction. So that is very similar to the connection that they were able to put on intrastate cannabis activities effect upon interstate commerce. And now we see the court moving in the opposite direction, away from authorizing federal authority over intrastate commerce. And then the final thing that has changed is the court itself. The court is now 6-3 conservative, and it's what's known as an originalist court. And it has announced, it has overruled a lot of precedent since it's been sitting. And it's announced the terms under which it will overrule precedent, because it's controversial to overrule precedent. And basically what the court is saying is it will overrule precedent that it doesn't agree with, and that doesn't honor the original intent of the Constitution. There is nothing that further from the original intent of the Constitution than the expansion of the Interstate Commerce Clause to allow regulation of intrastate commerce. So those three things, Guillermo, are coming together, allowing a guy like me to write a tax opinion that says, hey, look, there's a reasonable chance that if you took this position on your return and you were to be challenged by the IRS, if you went up to the Supreme Court could, there's a reasonable chance that it will either overrule Gonzales v. Raich or find that because the facts are not applicable, that it doesn't apply. And that's what we see going out there. It's a challenge. It's just starting. It's not established yet. Gonzales v. Raich is still binding Supreme Court precedent. And for that reason, you need a good reasoned tax opinion to get over binding Supreme Court precedent and establish that you have a reasonable position that can be defended if the IRS should show up. And you should assume they will. You should assume they will. Next slide, please.
And
okay,
and Nick, just a good place to pause. I just want to make sure I get some of the questions, and this is going back a few slides. When we started the 29 million to, I know some folks are thinking, well, how does this apply to me? When we went back to the 29 million limit for the small companies, is that based on gross receipts, revenue? You know, is there a way to specifically define that so someone could identify it if they're kind of thinking about their own tax situation?
Top line revenue, yeah, gross receipts.
Just top line revenue, okay. Yeah. And then this is really going over to a separate topic, which would be the reschedule. I think we'll get into a little bit more of that at the end of the webinar. It is separate, but Naomi did ask, is the rescheduling going to apply to both medical and adult use, use only, or only to medical?
Well, so it's just it really just applies to medical, right? Because it creates a medical class, right? We're moving. The suggestion is to move it to Schedule 3. Schedule 3 is pharmaceutical drugs. So it is a medical. It doesn't legalize the current industry at all. But as far as 280E is concerned, it removes 280E for both medical and adult use. Yes.
Recreational use. Okay.
That's right. Okay, so just real quick, we all know this, right? But the important thing to understand is, Truly filed for 19, right? And if they win, that means 280 didn't apply starting in 19, right? And many companies out there want to protect their ability to benefit from that, and they have 3 years from the filing date of their return to file an amended return. If that 3 years is gone, you can't file an amended return, right? And some things important to understand as well is that you have a new client and you might not be sure when they filed their return, right? And if you pull IRS transcripts, remember, IRS transcripts don't give you the filing date. They give you the received date. And a timely mailing is timely filing. And it isn't the received date that is the date that you filed the return. It's the date that it was put in the mailbox or that you hit the send button on your computer. And that's really important when you're filing amended returns, because if you file after that date and use the IRS date and it's not the filing date, you just filed late. So heads up on that. Again, these are uncertain tax positions, right? And this one in particular is taking a position contrary to binding Supreme Court precedent. You need a tax opinion and disclosure for that. Those are two different things, Guillermo. The tax opinion goes in your file, right? The disclosure goes on your tax return. The opinions that I'm writing are long, and then the disclosures are a summary of that opinion that goes on the tax return itself. If you're contemplating this position, and you should contemplate it, you should also just put it in your thinking that you're going to get audited, and that should be. You shouldn't try to do this if you think you're going to get away with it and not get audited. That's not the reason to do it. The reason to do it is that you want to protect your ability to benefit, you believe in it, and you understand that you could get audited, and you're ready for that.
Yeah. And Nick, we have folks on the webinar probably thinking through this and saying, okay, when is my deadline and what are the tax years? So can you clarify, when you look at the last 3 years, which tax years would it be, and what's the deadline?
So we
year,
might be
2020
might, so 2020 might still be open if the taxpayer filed in the fall. Most likely 19's gone, but probably 2020 on. If we move quick, certainly 21. There's one other thing. It's 3 years from the date that the return was filed, or 2 years from the date of a payment as well. So if they filed on time but paid a couple years later, that year might still be open, limited to the amount of that payment, of course.
Okay. And that's just something you could discuss if someone reaches out to you. But if they're thinking through it before they connect with you, it's those two things you just mentioned to think, how much more time do I have to make the decision?
That's right. And it's also one of the bullets on this slide is amended returns versus protective claims. There's different ways to do this, and that's part of the discussion as well. A protective claim is sort of a placeholder. It satisfies that 3-year statute, but it just sits in the queue, and then every year you get a letter that says, hey, taxpayer, we're holding this protective claim for you. What do you want us to do with it? Do you want us to process it, or do you want to withdraw it, or should we get back to you next year? And so it just keeps the door open. The IRS doesn't look at it. They don't process it. So it doesn't change an existing tax liability. It doesn't trigger a refund. It doesn't do any of those things. It doesn't change what your estimated payments will be for the next year either. But it does keep that 3-year statute open. And it might be a tool to use if you're a little leery of an audit, but you don't want to miss the opportunity. That would be a way to secure your ability to benefit down the road if it's successful.
Okay.
Yep. Okay, next slide, please. Okay, here we are, Schedule 3, right? Happy day. There's a lot of controversy around this. I would recommend that everybody, give a comment in this process. Right now, we are in a notice and comment period. It started about 3 weeks ago. It's 60 days. What has happened with moving towards Schedule 3 is, if you recall, about 2 years ago, a year and a half ago or so, President Biden made an announcement right before the midterms, right? These things have political implications, that the HHS, the Department of Health and Human Services, should study marijuana and issue a recommendation around rescheduling. And then he also pardoned individuals who had federal possession crimes at that same time as well, and kind of recognized that the Controlled Substances Act was unfair as applied to marijuana, and that people who were arrested because of it being a controlled substance, that those arrests were wrong. That was a couple of years ago. That started the process. And back in maybe October, a little bit earlier last year, the HHS report was leaked and it came out, and we learned that what the report says is that that marijuana is not suitable to be a Schedule 1 or Schedule 2 controlled substance. In fact, it's safer than alcohol, and it should be moved to Schedule 3. Why shouldn't it be removed like alcohol was? Alcohol and tobacco were exempt from the Controlled Substances Act. In order to get it passed, southern states wouldn't vote for the Controlled Substances Act unless alcohol and tobacco were exempt. That was back in the Nixon administration. So here we are now. We're in this notice and comment period, 60 days to make a comment. Schedule 3 is the schedule that is a pharmacy level schedule. It's things like steroids and Tylenol 3 and things like that. So you still need a prescription. It's not going to make the current industry legal, but it does do away with 280E, and that's a big deal. It doesn't solve banking, doesn't do any of those things. But it is a big step, right? And Nick,
this would be a good place to ask. We were chatting about it before the webinar. We were just talking in the background. But does 280E go away for the current 2024 year or in 2025? And
Yeah.
I can tell you that there's another reason to think through it too, is if does the reschedule really go through as planned in the current year, right? So there's a variety of opinions on this in the sense of, or position, I should say, whereas some taxpayers are still making their estimated tax payments and assuming that 280E applies in the current year, and some are not, whether it's folks that I've been interviewing through my podcast or just going out and talking to folks. But also the MSOs have different ways of looking at this as well, that they've talked about publicly. Do you have some thoughts on when it really goes away? What's the probability? If the reschedule happens this year as planned, which tax year does it really go away?
And Guillermo, I think I have a slide on this as well. Might be the next one. So it may have already gone away. And Guillermo, I think we can go past this one. I kind of hit that already. Yeah, 7805B, right? So Section 7805B of the Internal Revenue Code states for tax purposes that regulatory changes are effective when they're published in the Federal Register. It contemplates that effective date could be upon publishing the proposed regulations, temporary regulations, or final regulations, actually. That's the part that I'm not sure of which one of those applies, but guess what? We already had the proposed regulations that were published, so 280E might already be gone. And I think it's important for the industry to take the position that it is gone. And even one step further, Section 7805 also contemplates that regulatory changes can be retroactive. And Congress and the Commissioner of Internal Revenue both have the authority to make regulatory changes retroactive, and taxpayers can request retroactive treatment. So Guillermo, I think every one of our clients on their 2024 return, and maybe their 23 return, and I'll talk about this, it should be requesting retroactive treatment. It seems justified, and it could be justified going back even further, because if you recall, we started this conversation in 2022 with President Biden's announcement that the Controlled Substances Act listing of marijuana as a Schedule I controlled substance was wrong. And if you read the HHS report, what you'll see is that the evidence that led to the determination that it was wrong was developed because of the medical marijuana industry. Their perseverance in enduring illegality for 20 years and dealing with 280E for 20 years has provided the record that actually marijuana is relatively safe compared to other drugs. And because they carried that burden, they should get the same treatment that individuals who got possession crimes got. They should get a 280E pardon. And that can be done through retroactive treatment. And retroactive treatment should be back to 2022, the year of Biden's announcement. So I think that's important for the whole industry to take a position that's justified.
Yeah.
And we as professionals need to start talking about that.
Right. And thanks for mentioning a couple of things, that, and as well as that we need to be involved in the comment period. I can tell you that I recently went on the link, put in my comments, and it's very easy to do. So it doesn't take a lot of time. I would even say, even with ChatGPT nowadays, type it up and get it cleaned up or however you want. But it really could take you less than 5 minutes, and we need everybody's support with that part of the process. And what I'll do is put a link when we set out these slides, because that's a great point, is that we need to support that as well. And so I'll put that link in the email that goes after the webinar.
Guillermo, I think I got one more quick topic. I see we're getting a little low on time, so let's just talk about now what happens with rescheduling, right? And you know, it's my position that 280E costs don't disappear; they're still there. They just are suspended. They can't be deducted. And once they can be deducted, now we should be able to reclaim them. That's the 280E capital asset position, and I think that's the next fight we're going to see. Is a fight to reclaim all these 280E costs now that we have rescheduling and 280E doesn't apply. And, you know, Guillermo, your comment around pay or incurred during the taxable year is Really important point, right? And now we're beyond, we're not paid or incurred, and now 280E doesn't apply. Shouldn't we get to take our ordinary and necessary business expenses? And doing so satisfies the definition of income under the 16th Amendment. We're no longer violating legislative intent because now deductions are allowed. And so there's a good chance that that one works as well. And I'm excited. I'm excited for the 24 year to see what we could do there.
Yeah.
Yeah. I think I got one more. So this case CBS is quite remarkable, Guillermo. Let's end with this. So in CBS, CBS is a U.S. company. And at the time of this case, CBS, there was what was known as the foreign source credit. I botched that a little bit, but something like that. Essentially, there was a 30% non-recognition of income for tax purposes from foreign sources and a corresponding 30% disallowance of deductions. And CBS had an airplane that it leased to a foreign airliner, and it honored that requirement. It only paid tax on 70% of its revenue, and it only depreciated its airplane at 70%. About 8 years down the road, it sold the airplane, and then it filed a return, and it filed that return as if that 30% disallowed deduction was no longer available. And then it filed an amended return, and it claimed it as basis in the airplane upon the sale. IRS said, nope, that's a disallowed deduction. You don't get it anymore. They went to court, and guess who won? CBS won. The court held that because it was not allowable during the taxable years, that it didn't reduce basis on the sale of the airplane, and for that reason it was recovered on the sale of the airplane. And Guillermo, the remarkable thing about that, and let's tie it back to 280E, right? 280E also disallows deductions. There wasn't anything in the Foreign Sales Act that says only these kind of deductions. It just disallowed all deductions at 30%, kind of like 280E, but differently, it also didn't recognize 30% of the income, right? You cannabis companies, you don't get that benefit. But guess what? CBS won, got to claim, got credit for its disallowed deductions, and didn't have to pay tax on 30% of its income, right? So the IRS is much worse off in that situation than they are if a cannabis company gets to recoup its costs now that 280 no longer applies.
Yeah, and unlike amended returns where we're talking about 3 years, this is all of the historical unamended disallowed expenses, right? So
that's the position I would take.
Yeah.
Yes.
Yeah.
And again, uncertain tax positions, right? Tax opinions and disclosures is all over this stuff.
Yeah. Okay. Well, we're getting close on time. We got a couple of minutes. Don't mind if we kind of go over a couple of minutes and have some questions, if you don't mind, Nick. So I'd encourage all the participants, if you had some questions that you were holding back, just go ahead and click on that Q&A button and go ahead and put those in the chat there. But one of the ones that I see right now is I'm sure what's going through everyone's mind too is you haven't taken any action on this, but you're maybe capitalizing some of these costs. We have a question from David, and he's asking, how exactly would you report currently non-deductible expenses on your tax return? I think this is someone that maybe not working with an attorney or a tax accountant, but is somehow capturing the non-deductible expenses and wondering how those end up on the tax return. So maybe if that's something you could share, is how those expenses end up on the tax return.
So Guillermo, I'm a lawyer. I don't prepare tax returns, right? And so I generally leave that up to the CPAs. I provide the legal basis to establish that the expenses should not be deleted. And then I've had different CPAs want to do it differently. I've had CPAs think about it as a deferred tax asset. I've had CPAs thinking about it as a balance sheet item. Frankly, I'm not a CPA, and I don't know the exact distinction between those two different things, right? But I think that there is some flexibility there to do it differently according to your comfort level, right?
Yeah. Right. And the short answer is that there may be different descriptions on it, but it's basically ends up as an asset on your balance sheet as long as you can identify it and you have the support on what those expenses are made out of. I think and
it's kind of like, think about basis, right? If my main practice is defending taxpayers, right, that are in audit and trial and kind of stuff like that. And I hate basis cases, Guillermo, because you got to go all the way to the beginning and you got to establish it, right? It doesn't matter what you put on your K-1, doesn't matter what you put on your tax return. If you can't prove that you got that those costs go to your basis, then you don't get them. And guess what else? If you can prove more than was on your tax return, you get more. So Guillermo, I don't think it's really that critical whether they were on the return or not. I think that you have to be able to substantiate them for sure, and that's really important. But whether they were on the return or not, I think they're still there. We just have to recognize them.
Yeah, your point there is kind of going back to what you said earlier. Is it's keeping good records to be able to identify them from the get-go, right? So when you do make the decision, you have the support and can support an audit, right? Because as you said, some audits have been successful, of many, but they were successful also because they had good books and records that tied into the tax return and they could support it.
That's right.
Okay. Well, good. Any other questions before we wrap up? Got maybe one more minute, and then we'll wrap up our webinar here. So the other thing to think through is does everything we talked about, it also applies to psilocybin, right? I mean, the main difference is that, that's not currently being rescheduled, but even as we move forward, I mean, other substances that remain Schedule 3, all of this really applies that we talked about today, correct?
That's right. Schedule 1 or Schedule 2. Yes, absolutely.
Schedule 1, Schedule 2,
and psilocybin and MDMA and all those things that are being legalized in Colorado and Oregon and soon to be other states are all Schedule 1, I believe.
Okay.
All the fun stuff.
and as anyone is thinking through, is there a deadline this year? You alluded to it earlier, but if anyone's thinking through this and wants to make sure they meet a deadline to get this filed, is October for this year, or when would be time to reach out to you? I assume sometime pretty soon in the near future, correct?
Yeah, it's a team too, right? It's your CPA, it's myself or another lawyer and you, and your CPA already has a big load coming up in the fall for all their other clients, and so need to get this done kind of before that crunch comes up, I think, and I think you're going to see a lot of these get filed in June and July, and August to kind of get them done, and then be able to have a normal filing season come fall.
Okay. And you're very active on LinkedIn, and I know a lot of the folks that participated today have read your articles. What is the best way to find you or reach out to work with you? Is LinkedIn the best way to reach you, or should we put your email address in the follow-up email here?
Yeah. And I see a lot of friends on the list too. It's good to see everybody. You guys know how to get a hold of me. I pick up, right? So my phone number is 720-370-1169. And my email is my name, nick.richards@gmlaw.com. I'd love to talk to you.
Yeah. And I can attest to that. I think someone introduced us, a mutual colleague, and I did call you and we had a talk, and that's how we connected. So it is really true that you're one of the few people that really does pick up their phone. So appreciate that.
Well, Guillermo, look, this stuff that we talked about today, it's been years in the making, right? And it's not just, me, it's the entire industry that has been thinking about these things. And there's been a lot of conversations that I've had with a lot of CPAs that have really helped me formalize these thoughts. And I really appreciate the opportunity to talk to you guys.
Yeah. And you kind of stole my thought there, because I was going to wrap up with saying that as soon as the information came out with TrueLeave, I mean, one of the best comments that I've heard is that we have to share all this information. If you're filing your return, whatever experience you're going through or whatever you can share, we need to be talking about it. I know some of the MSOs have been kind of hushed, but I think that has a lot to do with what they can say publicly. But even behind closed doors, or sharing is something that we have to do as an industry, and work together and share what we do know, because these are it's big dollars, right? And it's been a lot of years being subject to 280E. So this along with the reschedule, it's just huge and beneficial for the industry from a just additional cash coming in. And so I think you're a big part of sharing that information and helping others, guide them along the way, whether working with you personally or on webinars and kind of like what we're doing here today. So we really appreciate your time today, and thank you for being here. And
Been my honor.
Yeah, thank you. Just to wrap up today, so want to put in here, this will be in the slide. So my information is here to schedule a free consultation. You could reach out anytime. And we do have a booklet that's going to be coming out that is focused on teaching you how to forecast cash. We talked about the amended returns today, additional cash, things to think through. And so I'll be publishing a guide on how to think about forecasting your cash. And we also have the Cannabis Success Show. We're really focused on sharing knowledge, doing what we did today, and sharing stories of success. Because I mean, you travel to conferences, there's a lot of challenges that people talk about, and sometimes I'm like, I just want to hear the success stories, and there are a lot of them, and I think we can really learn a lot from each other. So that's what we tried to do on our podcast, on our webinars, and we hope this was beneficial for you today. Thank you, everyone, for your time.
Thank you.